Hi. Hi.
What happened? So you have diversified your portfolio, right?
Diversify?
Okay. So what just happened with Nityam happens with a lot of retail investors. Let me explain. So think of diversification as this. Let's say you're someone who prefers UPI all the time and you don't carry your cash or cards. But one day suddenly there's a problem in either the UPI apps or the network and now you are stuck. But this won't happen if you carry other options like card or cash. This is diversification in real life. But how do we do it with our finances? What are the options available? All of these questions will be answered. But before that, let me tell you something. I came across this article that mentioned that a lot of Indians under the age of 30 are allocating almost 70% of their portfolio to equity, either through individual stocks or equity mutual funds. But why is this a problem? Because if there is a market crash, a short-term one, or a market correction, you will lose a significant amount of your portfolio. And this is exactly what happened during COVID.
Where do I diversify and what instruments are available?
Okay, so there are a variety of instruments that you can invest in. We'll look at the most popular ones and the most accessible ones, and we'll evaluate them on three basic parameters: the risk, the returns, and the most optimal duration. Okay, let's start. Under equity, you have stocks that we can directly invest through brokers or through mutual funds. Now let us look at the parameters that we discussed about in the beginning. For simplification, we'll be using the Nifty Bs, which mimics the index, as in the whole market, though this is an oversimplification. See, now in the past 10 years, if Nityam would have invested rupees 10,000 in March 2015, then by March 2025, that is this year, he would have had 35,000 rupees, which is almost 3.5 times with a yearly growth of 13.6%. But wait, this is not a straight line. Look at this. In 2020, during COVID, there was the worst fall, a drop of 34%. That is, the 10,000 rupees would have grown to 15,000 and from there back to 10,100 rupees. Now the question is, will you still be able to hold it when you see such a big loss in your portfolio? Okay, now that we know how this works, let us rate this instrument. If you look at the stocks, the risk is 5 on 5 and so is the return. The return is high. And the best time horizon is generally long term, that is more than 7 years. Because in the short term, this is pretty volatile. For mutual funds, again, the risk is 4 on 5, moderate to high. The return is good, 4 on 5. And the best time duration is 5 to 10 years. Now if we look at the index funds, which are pretty similar to Nifty Bs that also replicate the performance of the index, the risk is quite lesser compared to direct stocks. The risk is moderate, 3 on 5, and the returns are good, 4 by 5. And the time period again is 7 or more years. So you invest your money in a debt mutual fund. No, it's not that complicated. Basically, your money is lent either to the government, called the government bond, or to other companies, called the corporate bond. So the government or the company pay an interest on that loan and you earn a fraction of it depending on your investment. Here you have two options. You can either directly buy the bond or put your money in a mutual fund that buys the bond for you. Government bonds are much safer than corporate bonds. But how do you buy these bonds? You can easily buy it through any broker once you have a demat account. For instance, you can buy it through Zerodha's Kite platform, and this is not a sponsored video, but let us go back to Nityam. He invests rupees 10,000 in a government bond in 2015. Then by March 2025, with an average return of 7.75%, he would have somewhere around rupees 20,000. The interest rates or the returns will fluctuate over the years, but he would never see anything negative in his portfolio. Okay, so now rating time. So bonds or debt funds are generally safer, so the risk is low, around 2 on 5 and the returns are also low, around 2 on 5. Now the best time horizon is between 1 to 5 years, so short to mid-term. Keep in mind that these are generally hedges in your portfolio, as these alone won't help you grow your wealth significantly. This is the most trusted asset in Indian families, not because our parents and grandparents bought it as an investment, but this acts more of as a security. Gold acts as a safe asset. And over the past few years, the prices have increased significantly. There are various ways that you can buy gold. Gold ETFs can be bought in any broking apps, be it Kite, Grow, Fires. You can even start an SIP in gold mutual funds, which is a simple way to accumulate gold. Then we have sovereign gold bonds, which are very similar to government bonds, but these are issued by RBI and can be easily purchased through banks, post offices, and even these broking apps. Now let us take the rupees 10,000 investment in gold back in 2015. Since then, the gold prices have increased by 180%. So that 10,000 investment would be worth close to 28,000 rupees today. Of course, this is much lesser than the equity investments during the same period, but here's a difference. In the market crash of 2020, when Nityam's equity portfolio was down by 34%, gold was down by only 13%. And that is why gold acts as a safety net. The risk is low compared to equity, which is 2 by 5. The returns are moderate, it won't multiply wealth, but protects it. So we'll rate it as a 3 on 5. And the best duration to see a significant return will be more than 5 years.
Equity, debt, gold.
Wait. Real estate abhi baki hai.
Real estate.
Yes, we can invest in commercial real estate. So back then, when we wanted to invest in a commercial property, we needed to have lakhs or even crores of rupees. But after that also, it wasn't easy. Dealing with legal paperwork and property maintenance was always a hassle. But now, even with a small investment as small as just rupees 500, we can own a share in these commercial properties. This can be done using REITs or real estate investment trusts. Basically, we invest some amount in a large pool of cash worth thousands of crores, and the fund manager invests this amount in commercial properties. The main profits from these investments are from the rental income and when the property value increases. These profits are then shared among the investors. Right now, there are these 5 major REITs in India, and one can invest in them through any broker apps. And these REITs were listed in 2019. So if you take the rupees 10,000 investment from 2019, the amount could have grown around 40% in 2025. REITs also pay you dividends through the rental income, so which means you not only benefit from the price appreciation, but also you get a steady cash flow. So that initial rupees 10,000 would have increased to rupees 15,000, including the dividends that you would have got along the way. The risk is moderate, about 3 on 5. Since commercial property rents are much more stable than stock prices, the returns are also 3 on 5, not as high as the equities. The ideal time horizon is at least 5+ years. Since real estate as an asset class is a little slower on the growth and needs time to show the value appreciation.
Let's invest in everything.
No. I'm not advising you to invest in everything. Neither do you all. So basically, where you're allocating your funds and how much to allocate your funds depends a lot on you, your age, your financial status, and a lot of other factors. And I am not the right person to tell you how to do it. This video is only for educational purposes, and the aim is to simply explain the different options, how they work, and their risk reward so that you can make better decisions. Always do your own research and consult a financial advisor before making any investment. Okay, so all of the instruments that we have discussed have different purposes. Like for instance, equity funds or even index funds will help you grow your portfolio over time. And on the other hand, gold and bonds will balance your portfolio. They'll provide you a cushion as they don't have very serious dips. But they will also reduce your returns a little bit. Okay, wait. What if I tell you that tomorrow I'll give you 1 crore rupees, but there'll be a 75% chance that you won't be alive? Would you want it? 1 crore rupee after 1 year, but a 50% chance. Then 1 crore in 5 years and 25% chance. See, this is entirely a personal decision driven by a lot of factors. But one thing remains constant. Diversification of portfolio will give you the peace of mind and the conviction to keep on going. Because the results will be compounded year on year and your wealth will keep on increasing. But the most important factor is you. You staying in the game and making the investments. One last thing. Higher the reward, higher will be the risk.
Options.